I think one of the things that numerous studies have shown over the years is that when you think about your whole investment portfolio, whether it includes property, shares, cash, bonds and so on, the most important decision is getting the right asset mix, because that will determine how you will go through share market volatility, through bond crashes, and over the long term. So studies show roughly that 90% of the return variability you get will be a function of your asset allocation, your exposure to the big asset classes. Well, I guess the best guide would be what Dynamic Market DMKT is doing at the moment, and it's roughly about a 65% exposure to growth assets. Within that, yes, we do have some Australian shares, but big exposures are actually to European shares, emerging markets, including Chinese shares, some commodity exposure. I wouldn't have much at all in government bonds. In fact, if it was just my own money, I didn't have to worry about short-term risk. I'd probably have zero in government bonds. But if you are going to have government bonds, you probably have Australian government bonds, or at least you're getting a 2% yield, not down close to zero, and bonds in the emerging world. So that's sort of, I guess, a flavour for it. Now, of course, if you've got money outside of Dynamic Markets Fund or DMKT, you'd also have some property. But in the property side at the moment, if you're an Australian-based investor, I'd certainly stay away from Sydney and Melbourne property. You'd be more focused on those parts of the property market that have been oversold. You'd be looking to sort of buy into those parts where prices have been falling. But commercial property, to me, I think is where the opportunity is, not so much residential property. But that's outside, that's all illiquid assets outside of what we do in DMKT. It's always hard to know where the biggest upside is going to come from, but I would tend to think it's going to be in those assets that have had the toughest time over the last year or two. It won't be in the US share market. The US share market is still within a few percent of record highs. It's not going to be the US share market. It's probably going to be, if I was to sort of say any one asset, I'd probably say the Chinese shares. I mean, that's where the biggest hit has come over the last year or so. Think about the big worries of June, July last year when we rotated our concerns between Greece, then China, then Greece, then China, and so on. China's story, I think, dramatically went out of favour, and that dragged down Chinese shares listed in Hong Kong to the point where they're trading on price to earnings ratios of around 6 or 7 times. Now in Australia, we're trading on 14, 15 times. So that's where the value is, and I think as investors get confident the Chinese economy is not about to fall apart, then that's where you're going to see the biggest opportunity in terms of percentage returns over the next, say, 12, 18 months.